thought that, oh, it would be bad if they didn't raise the debt ceiling. No, it's bad if they do. And again, this should be good for gold. Raising the debt ceiling means more debt, more inflation. That is positive for gold. Gold has had a pullback recently. I'll get to that a little bit later in the podcast. But all of this should be bullish for gold and bearish for the dollar. Another piece of economic news that we got last week, again, real bad. I mean, almost all the news was worse than expected. I'm just focusing on a couple of ones that were particularly problematic late last week. The Chicago PMI, right? That was supposed to be 47. It came out at 40.4. Actually, no, that is today's data. That number came out today. I jumped ahead of myself. Hold on, I got my slides mixed up here. The Richmond Fed manufacturing. Let me talk about that one first because that was last week. That was supposed to improve from minus 10 in April to minus 8 in May. And instead of improving, it got worse. It went to minus 15. So it was already bad at minus 10. And then it came out to minus 15. Now we know we're not manufacturing because that's one of the reasons that our trade deficit went up. That's one of the reasons our exports went down because we can't export stuff that we don't make. And if we're not making stuff, well, that's going to be reflected in these weak manufacturing numbers. And that is exactly what's happening. The other data point I wanted to talk about from last week that came out on Friday, which was one that the markets did pay attention to, unlike the trade deficit, which, they completely ignored. And that's the personal income and spending numbers. And the income number was pretty much in line. It was up 0.4. But the spending was up double estimates. They were looking for up 0.4, and we got up 0.8. Now, why are Americans spending so much more money? Well, obviously, it's because stuff costs more money. That's the real reason that spending is going up, because prices are going up because of inflation. And in fact, even in the data, the PCE, and apparently, this is the Fed's favorite way to measure inflation. And that's because it's the least accurate, right? It's the lowest number because it has the most substitution and hedonics and, sleight of hand. That's why the Fed likes it, because it puts the best possible spin on inflation. But even those numbers, they were looking for the month over month PCE to go up by 0.3. It went up by 0.4. But more important, the prior month in March, it was only up by 0.1. So we went from 0.1 in March to 0.4 in April. Despite the rate hikes, these numbers are going in the wrong direction. The same thing for the core. The core PCE was supposed to go up 0.3. It went up 0.4 versus 0.3 in the prior month. And look at the year-over-year numbers. Last month, the year-over-year increase in the PCE was 4.2. Now it's 4.4, higher than the 4.3 expected, but more important, above the 4.2, going in the wrong direction. And if you take the core year over year, stripping out food and energy, again, 4.7 for April. It was 4.6 in March, going in the wrong direction. Inflation numbers are getting higher, not lower. So how has the Fed made progress? How are we moving inflation towards 2%? When it's moving in the opposite direction right now, and rates are already at 5.25%, and we're potentially going to get another rate hike in a couple of weeks during the June meeting, when rates are going to be 5.5%, 5.75%, right? Adding to the inflationary pressures that are already in the economy because we are increasing the interest expense that everybody has to pay on the enormity of debt that already exists. Now, I want to get to the data from this week. I just started with the Chicago PMI. I already kind of, let the cat out of the bag on that one because I read it off. But again, I'll say it again. That came out earlier today, and it was a horrific number. This is like the worst Chicago PMI, since the financial crisis. It was supposed to be 47, a little bit down from the 48.6 in April. And it plunged to 40.4. I mean, The low end of the range was 44.5, and we're a full 10% below that number. This is a horrific number for the Chicago PMI. And of course, we've been down, I forget, something like 13 or so months in a row. So we've been in recession for a long time, according to this number, and it's actually getting worse. Now, when this number came out initially, there was a sharp rise in the price of gold, about $10, $12 immediately. Gold spiked when this number came out because this is bad news on the economy. But then about 15 minutes later, we got the JOLTS report. And then gold lost almost the entire rally. Didn't quite go negative. It went, from up like 10, 12 bucks to up maybe $2 or $3. As soon as this JOLTS number came out, which kind of boggles the mind because the JOLTS number showed a huge increase in the number of jobs, openings, over 10 million. It was 9.59 million in March. And that was revised up to 9.745 million. And the consensus for April was for a drop to 9.35. I mean, why do people think this? Well, people are losing their jobs. All these layoffs are being announced. People are, losing their jobs. And now you have all, people implementing or starting to implement AI, and you're getting some job losses there, but you have job losses in the banks and the financials, and a lot of these companies, money-losing companies, are having to cut their burn because they don't have access to capital. So people expected the number to come down. Instead, it went way up, which makes no sense. I don't even believe these numbers. One thing in this is they give you the so-called quits rate, which lets you know how many people are quitting their jobs, and that went way down. And so that doesn't show a strong economy because normally, you don't quit your job unless you think it's easy to get a better job. So in a strong job market, people are likely to quit, right? But if the job market is weak, you're kind of going to stay put. You don't want to take your chances in the labor market because you may not get something as good as the job you have. And so the fact that the quits rates are going down would suggest that the labor market is not really as robust as this JOLTS report would suggest. So, but this is the only really strong number that we've had in the last week and a half. I mean, we've had a couple of numbers that might have been slightly in line or a little bit better, but not like that. But most of the numbers have been like the Chicago PMI, maybe not quite as bad as this one, but they've been worse than expected, and they're all flashing recession as the Fed is hiking rates and as inflation continues to get worse. But meanwhile, the markets in the month of May have been oblivious to all of that, right? They're not paying attention to any of the stuff that's really going on. Nobody sold in May and went away, unless you're talking about people who own gold stocks. But May was a huge month for the stock market, particularly the NASDAQ. I want to go over that. So the month of May, which ended today, this was the last day of the month, and the NASDAQ was up 6% in May, 6%. And if you look at the NASDAQ 100, right, the QQQ is the ETF for the NASDAQ 100, the biggest NASDAQ stocks, that was up 8% in the month. That's it. I mean, it's a huge number, led by NVIDIA, right? NVIDIA was the biggest gainer. It was up 36.5%. And that was with like a 5% decline. I think it was down today by that much. I'm going to take a quick look at it. 5.6% on the day. But even with that decline, you still had like 36.5% increase on the month. And you had other stocks, Google, Meta, a lot of these big stocks that are perceived to be the main beneficiaries, the initial beneficiaries of the AI revolution. Those stocks saw the biggest inflows and the biggest gains during the month of May. Now, if you take those stocks out of the game, there really wasn't much going on. In fact, the S&P 500 was only up about 1/3% during the month. All of those gains attributed to the big tech stocks that are part of the S&P 500. If you look at the Russell 2000, which doesn't have all these tech stocks, it was down 1%. The Dow was down 3.5%. My 401k, yep, better than being in stocks, but that's just for now. As I said, the biggest losses are going to be the people who are in cash. People who are in T-bills. Oh, the market's already closed. Look at how much time this is. I didn't realize we were after 4 o'clock. Dow ended up down 582 points. That's 3%. But they sold off the gold stocks into the close. So the GDXJ only up 6.7, or GDXJ up almost 10. But let's look how some of the individual larger mining stocks were. Newmont up 2.7, not much move there. Barrick Gold up 6.7, a bigger move there. Let me see, Yamana as a mid cap, that's up 9%. All these stocks are way off their highs. Goldfields, South Africa, up 15% on the day. So a bigger move. Kinross was up 9.5%. All these are good moves, but they all sold off on the close, which is pretty common. I mean, I watch the gold stocks quite a bit, and I still think there's a lot of selling on the close. And that's because a lot of the buying in the gold stocks is day traders, right? There's still no real money that has moved into this sector. You get some day traders that get long in the morning. They ride the rally up a little bit, and they want to close out their positions. They're trading on margin. They don't really have enough money. So this is all a bunch of noise right now. When the real money, when the institutional money starts moving into these stocks, when they finally figure out what I've known for years, and everybody decides that they need to have some gold stocks in their portfolio, these things are going to explode, right? If I'm right. I mean, they're not going to just go up 9 or 10%. I think we're going to see some days where you see 30, 40, 50% moves in big gold stocks because some big brokerage firm put out a buy recommendation on one of them. Oh, everybody needs to buy this. Nobody owns these stocks right now. See, once the institutions think it's safe to buy, once buying gold stocks becomes the conventional wisdom, then everybody's going to do it. See, right now, it's like, I don't want to go out on a limb and buy gold stocks because nobody else is doing it. And if I buy a gold stock and it goes down, then they're going to say, why'd you buy this idiotic gold stock? What are you, some kind of kook? What are you, like a Peter Schiff? You're fired. Get out of here, right? But if everybody else buys a gold stock and you buy it and it goes down, well, you're covered, right? Because you just did what everybody else does. If everybody else starts buying a gold stock and they all go up and then you don't buy one, and then your shareholders meet with you, what are you, an idiot? Why didn't you have a gold stock? Everybody else bought a gold stock. What are you, some kind of moron? You're fired. So once everybody buys them, then everybody wants them. And of course, by that happens, the price goes through the roof. I don't want my clients waiting for everybody else to buy. I want to buy before the herd, not with the herd or after the herd. Let me see how many more questions I have because it's already past the time I wanted to stop. All right. I mean, when did I start at 1? Yeah. So, all right, I'll go till 5. That'll be 4 hours. Can I get a little bit more water? As I said, these are like telethons, like the Jerry Lewis telethon, except I'm not on my feet the whole time. But you see me, I squirm around on my seat because my butt gets sore just sitting in this chair for all this time. I got to take some of the pressure off by getting up a little bit. But I'm sure I know I'm going to have a lot of calls to make because I'm getting a lot of messages and stuff. I got voicemails on my phone. So when I finish this, I'm not done working. I got stuff to do because, I've spent 4 hours doing this podcast video and now I got extra work. My birthday is, I'm going to be working my ass off on my birthday here. Let me see. Hey, Peter, U.S. experiment with MMT. Yep. Modern monetary theory. Yep. Nothing modern about it. It's really not monetary and it's not a theory because a theory you have to have the, presume it is viable. Now it could look viable in the short run. Yeah. And that's what makes people think it could actually work. But it's all an illusion. It doesn't work. It just makes problem bigger, but they're hidden from view. But then when they blow up, you have to find something like the coronavirus to blame it on. Eric, what will trigger the loss of confidence in the dollar? It's going to be just a loss of value. At some point, prices will be rising fast enough that people will lose confidence. And it all is a confidence game. It's a con game. That's the only thing that really backs up the dollar is confidence in its future purchasing power. And once the confidence is lost, there's really no way to restore it. It's a death spiral. And I think, unfortunately, the dollar is going to die. And the only way to resurrect it will be if it's backed by gold again. That'll be it. And the dollar initially is defined as a weight of gold. That's what a dollar was. It's a measure of gold. The dollar actually describes
a measure of gold, how much gold you have. So the dollar is a weight of gold. That's what it is. We turned it into just a piece of paper, but that's not what it's supposed to be. But that's what it needs to be again. Love your podcast, Peter. This is love your podcast. Do you think wages will rise anywhere near fast enough to keep pace with hyperinflation? Not a chance. All prices will rise in hyperinflation, including the price of labor, wages. But a lot of people are going to lose their jobs in hyperinflation, so their wages will be zero. And their unemployment checks will not rise nearly as fast as inflation. But even people who have jobs, wages will lag the cost of goods. So everybody is going to be impoverished through inflation. The stocks will go up more than the price of gold, right? I think a lot of the foreign stocks that I have could go up more than gold. And I think they'll deliver good dividends that you can live on. So this is what we're doing. I'm building portfolios that I think will outpace inflation because there's no way your wages will or any of your government benefits. Paul, can you bring me water? I really need some more. All right, let's drop. Happy birthday, Peter. I heard you mention that you would be hiring your asset management in Puerto Rico. Yeah, there's nothing on the website about it. You just got to send an email if you're in Puerto Rico or you're thinking about moving to Puerto Rico. It's really good if you're in the business, you have a license or something. But you can email Paul at schiffradio.com. But yeah, we don't have anything on the website because we're not. I don't know how many people we're going to hire. We'll see. But we're not even in Canada. But I can still use a couple of people. But I'm talking to a couple of people right now, so I'm not really sure. But obviously, over time, we'll be hiring people. So it can't hurt to send us your information. Could we be on the path to a guaranteed basic income? Yeah, we might have the guaranteed basic income. That was a campaign issue for Andrew Yang, and all of a sudden you got Republicans, Mitt Romney, who was the presidential candidate who lost to Obama. He's advocating some kind of basic income. I don't know if it's a permanent thing or just a coronavirus emergency. But look, the problem at some point is going to be the checks aren't going to buy anything. What good is it if you have a basic income if your basic income doesn't buy you anything? That's the problem. Now, there are other problems with it, but that's the biggest. If we're going to have hyperinflation, none of this is going to matter. Your income isn't going to matter. It's what you can buy with that income that's going to matter. Thoughts on the British economy? I had a lot of thoughts on the British economy. Don't have enough time to really address them. I think they're better off leaving the European Union. I would have been in favor of Brexit if I was over there. But what they need is less government, right? Part of the idea was they didn't want to deal with all the government in Brussels, which is good. There's too much government in Brussels, but there's too much government, from down at 10 Downing Street or from Parliament. It's not that the British needs less government from Brussels. They need less government there in London. They need a smaller government. And so they need more freedom. They don't need bailouts and stimulus and artificially low interest rate and inflation. The Bank of England's drunk from the same Kool-Aid. They're pursuing the same irrational monetary policies. The one good thing that's going to come out of this is at the end of this, when we have this currency crisis, all of these guys, their reputations are going to be destroyed. Their theories are going to be completely and utterly discredited. And so hopefully we'll be able to, have sound money and have a rethinking of all this. And so that maybe we'll embrace sound money again and have, the conventional wisdom actually be wise instead of completely idiotic, which is what it's degenerated to. What books or chapters have been most insightful? Look, I don't know. I read, as a kid, I read Rothbard, and I said I read Hazlitt. I read Ayn Rand. I read Austrian free market thinkers, libertarian, older philosophers, and I had my dad. I read my dad's book, The Biggest Con. And, the book that I turned into a book with my brother, How an Economy Grows and Why It Crashes. His was How an Economy Grows and Why It Doesn't. Kingdom of Malts, my dad. We still have copies. I don't know how many we have left, but you can go to my website, shiftbooks.com, and get I still have some copies of The Kingdom of Malts that my dad wrote. I don't have any copies anymore of The Biggest Con. You can find a few on eBay or Amazon. I don't have any to sell. I have a few, but I'm not selling them. I want to keep them. but I still have a few of the Kingdom of Mosses left. And we have our own books, I think, or you can go on Amazon and order my books, Crash Proof. Crash Proof 2.0 is the more recent one. Get that one. The Real Crash, the revised edition. You can get that on Amazon. Or I think I have a link to that through shiftbooks.com. And then if you're going to get How an Economy Grows and Why It Crashes, try to get the collector's edition if you can. If not, just the regular edition is a little cheaper. But I think they're all kind of discounted now on the online booksellers because they're older. They're several years old now, but they're very, very valid. They're in fact probably more relevant now than they were years ago. Agree the U.S. dollar will decline, but where will foreigners end up parking their cash? Yeah, well, they'll get out of dollars either into other currencies that they think are less bad, or in gold, in silver. A lot of the cash isn't going to be parked. It's going to be lost because when the dollar crashes, a lot of wealth is going to evaporate with it. So people will lose that. But what they're able to get out before the music, also my computer froze up. All right. If they get out before the music stops, yeah, and they'll put some into stocks, into equities, into other assets, into real estate, whatever. But I mean, a lot of money just disappears. If you were in your 30s and had $500,000 that you can get with a couple of weeks, what would you do with it? I would send it to me. I would open up an account at Euro Pacific Capital and invest that $500,000. I would talk to one of my representatives. And get a plan. Like, let them know all of your particulars, all of your your goals and your objectives and things like that. And help. And I can manage that portfolio. If my strategy is suitable for you and my representative, we can determine that suitability. Then get invested, and you can talk with him about which type of strategy. A separately managed account, a wrap account, certain funds, brokerage, app managed, whatever. But go to Europac.com and call the 800 number, or just fill out a form to have a broker get a hold of you. And congratulations for being in your 30s and having any money. I mean, most Americans are broke. They don't have $500, let alone 500,000. So that's good. But what you need to do is preserve the purchasing power of that 500,000, because one day $500,000 may mean nothing, right? It may be just pocket change. So before that happens, preserve it by spending it now, not spending it on consumer goods that will depreciate, but acquire real assets that will hold their value, potentially appreciate, and pay dividends. If you were 22 in Canada, had about 200,000, what would you do? Again, is that California? No, I think that's California. Yeah. No, Canada. Well, send it to me if I could. I'll be in Canada soon. Just let my representative know that you're a Canadian. In the meantime, you can buy some physical gold up there or something. Send an email to us. Go to Europe Pacific Assets or EuropaCificFunds.com. Anyway, I'm out of questions. Oh, well, that's a good thing. Anyway, since I got to all the questions, I think I'm just going to end the podcast. I'm out of questions, right? Because there's nothing left for me to read.
Yeah.
All right, so I'm going to end it. I'll cut it a little short, so I won't go the full 4 hours. But as I said, there's a lot of good stuff in here. Hopefully, people can actually sit through and listen to the entirety of it, because I answered questions, but all throughout, I interjected a lot of important stuff. Which maybe we can even grab some of that important stuff and piece it together and make a shorter video out of that, so that maybe people that can't sit through 3.5 hours. But I know people listen to the Joe Rogan's podcast. It's 3 hours, sometimes closer to 4 hours. So yeah, especially now, when a lot of people don't have anything else to do. And again, the airwaves are filled with a bunch of nonsense. The news, financial and regular news, everything is wrong. All the opinions are wrong. Maybe, once in a while a guy like Jeff Gundlach comes on and says some things that are right. But even he sugarcoats it a lot. He may be, dumbing it down for the audience. Maybe he's afraid to say some of the stuff that I'm saying. Although I don't think he's quite as bearish as me, but I think he's probably closer to me than the mainstream. That's how ridiculous the mainstream is. But most of the people that come on, just complete nonsense. They're just talking to bail themselves out. They're trying to save their own butts from mistakes that they made, and they need these government bailouts. And they're trying to pretend that it's for the country, Or maybe some of them actually think it's for the country. Again, a lot of these guys don't know, right? They're drunk on the same Kool-Aid as everybody else. They actually think that bailing them out actually bails out the country. They don't understand how capitalism works. I mean, which is very frustrating because you have some of the most successful people in capitalism, people who have made billions, right, in at least a somewhat capitalist economy, having absolutely no understanding at all of the system that helped make them rich. Now, the problem is a lot of the guys on Wall Street, the hedge fund guys, they didn't get rich because of capitalism. They got rich because the central banks polluted and destroyed capitalism. And as they did that, as they siphoned all the capital out of Main Street, they enriched a lot of these speculators on Wall Street. So it's no wonder that they don't understand the problem, right? Because they got rich off the problem. So they don't want the problem solved. They want the problem perpetuated. Bye for now. And again, thanks everybody for contributing and for wishing me a happy 57th birthday. Bye-bye.
Who's left to buy? Nobody. Everybody's already bought. You just got a bunch of people who are looking to profit from the halving who want to sell. And in fact, as I expected, as I said on my last podcast, that they may not have bought the rumor, sell the fact. They might have sold on the rumor of the fact. And that's exactly what they did, because even though the halving didn't happen until today, Tuesday, the real break, I think, in Bitcoin was on over the weekend, was a Saturday or Sunday. And all of a sudden, Bitcoin in about, 5 minutes, fell almost 2,000. It went from about 10,000 down to almost 8,000 in just 5 minutes, 10 minutes, collapsed. It immediately bounced back to around 9,000. As I'm recording this now, it's 88 and change. But we got that big sell-off leading up to the halving. And of course, by the time the halving happened today, it was a yawn. It had no impact on the price. But we did get a big sell-off leading up to the halving, because I think the people who were speculating were worried if they waited for the halving itself, the price might have dropped. And so they front ran the halving, and they decided to sell in advance, which is something I thought might have happened. And I talked about it on the last podcast, and that's exactly what did happen. But now I think you still have a lot of guys who bought in front of the halving, who were intending on selling at a higher price after the halving, and may have to settle for whatever price they can get. I think a lot of disappointed Bitcoin speculators are going to be selling, and there's another leg down. That initial 2,000 point dollar drop was the beginning of a bigger move. We barely got above 10,000. I mean, we got to like 10,100. There's so much resistance up there. Even with all the hype of the halving, we couldn't even really sustain a move above 10,000 going into the halving. We got that big sell-off. Now, we did get yesterday the Paul Tudor Jones interview on CNBC, which I thought was another catalyst to make Bitcoin go up, and that maybe if he was not positive on Bitcoin, it would end up being a negative. And what happened was the Bitcoin rallied sharply. It started a few hours before Tudor Jones was going to be on CNBC. And I watched the rally. It was a sharp rally. And as soon as Paul Tudor Jones started to talk, that's when the rally peaked. The absolute price of Bitcoin, it was over 9,000. Forget where it was, 91, 9,200. But it peaked just in the middle or as he started to talk. And it sold off as he was talking. And by the time he finished, about half the gain had been gone. So it was clear that a lot of Bitcoin people were trying to trade Paul Tudor Jones. They knew he was going to come on. They expected him to talk positively about Bitcoin. And so they wanted to use it as a trading opportunity to buy the rumor of John Paul Tudor Jones and sell the fact as he spoke. And that's exactly what happened. And you can actually see that trade play out in real time, just perfectly. But I think it really was just, a symbol of what's happening on a broader scale with the halving. It's a much bigger buy the rumor, sell the fact. And so it's not playing out in as short a time span. It will take place over a longer period of time. But just to talk a little bit about what Paul Tudor Jones said, because he didn't give a glowing endorsement of Bitcoin by any means. He did admit that he thinks he has 1% of his portfolio in Bitcoin, and he thinks it could be a little more, that it's no more than 2%. It might only be 1%, but he's not really sure, right? He didn't know exactly. But clearly, if he's only putting 1 to 2% of his portfolio in it, he regards it as extremely speculative, right? I don't know what percent of Paul Tudor Jones' portfolio is gold, but I'd be willing to bet it's at least 10 times as high as his Bitcoin allocation. And I think the reason that he's keeping the allocation so low is because he realizes there's very good probability that Bitcoin's going down and he's going to end up losing money on that position. And so he wants to lose money on a small position because you can overcome that. Now, he did leave the window open, the possibility that Bitcoin could be his best performing asset, that in this environment of massive inflation and money printing, that Bitcoin really could take off. And since he's so confident there's going to be inflation and a rush into gold, and I agree with him on that, he just thinks that Bitcoin might be the fastest horse in the race. And so why not bet a little money on gold, on Bitcoin? Because if gold goes up because of inflation, maybe Bitcoin will go up a whole lot more. So let me throw 1% of my portfolio into Bitcoin just in case. And that's, I think, the position he took, which is not a big position because after all, most of the people who own Bitcoin today, the vast majority, probably have a lot more than 1% of their net worth in Bitcoin. I mean, I would say that most of these Bitcoin fanatics, their entire net worth, it could be in Bitcoin. I know that guy, Anthony Pompliano, I get into some wars with him on Twitter once in a while, otherwise known as Pomp. You know, he's talked about the fact that half of his net worth, and I think he's got a pretty decent net worth, but half of it is in Bitcoin, right? Well, you got all these Bitcoiners that are so excited about Paul Tudor Jones saying people should buy Bitcoin. Yes, with 1% of their portfolio. So if you've got 50% of your portfolio in Bitcoin, you're not following Paul advice, Paul Tudor Jones advice. Can you imagine if all the Bitcoin holders decided to follow Tudor Jones advice? Right? Imagine. Right? They'd have to sell 90% of their Bitcoin, right? There would be a crash in the Bitcoin market. If everybody who owns Bitcoin went to follow that advice, the market would crash. Now, I know people are going to say, well, but what if everybody else in the world just decides to follow Tudor Jones and put 1% of their net worth in? If that happens, then, well, I'm going to make a fortune keeping half of my net worth in there, which is true. But the odds of that actually happening are very slim. That's why that's a 1% allocation. Because if you lose 1% of your portfolio and you're a good trader and you're making money on other things, and I'm sure Jones is going to make a lot of money on his gold positions, whatever they may be, and maybe he's got some gold stocks. I think he'll make so much money there. Blowing 1% on a Bitcoin gamble is going to be no big deal. But if you've got half your net worth in Bitcoin and you lose that, you may not recover, especially if you're one of these Bitcoiners that thinks gold is obsolete now and you own no gold, you own no silver, you've gone all in on Bitcoin. There's no way that Jones is going to do something like that, right? He's absolutely. So to say that, hey, this is the reason you should buy Bitcoin because now a hedge fund manager who is speculating on inflation. First of all, Paul Tudor Jones is in the minority, right, of people who are looking for stagflation, right, that kind of agree with me, right? There's a handful of us out there in the economics, and there's some people, you got Ray Dalio who says a lot of the same things that I do. So there's other big fund managers that are seeing stagflation, but there's not that many that even are worried about it. And if most of the people who aren't even worried about inflation now and who see no reason to get out of the dollar, if they become worried about inflation for the first time and they really want to seek out, exposure, a hedge, something like gold, what's the odds, right, that are they going to go for gold or are they going to go for Bitcoin? If they don't own anything right now and they're managing institutional money, they're conservative by nature, they move slowly, and all of a sudden for the first time, they're worried and they want to hedge. Are they going to pick something like gold that has real intrinsic value, that's been a store of value for thousands of years, or a cryptocurrency that's 10 years old and they have no idea what it's ever going to be worth because it has no current intrinsic value. Are they going to gamble on Bitcoin, or are they going to play it safe with gold? Right? Obviously, gold is their next move. I mean, Jones already has a bunch of gold. He already has probably a bunch of gold stocks. All right, I'm going to take a flyer on Bitcoin. And who knows how long he's going to be in this Bitcoin position. You know, once this thing really starts to fall, he might cut his losses. He might get out when he's down 20, 30%. He may not ride the thing all the way down to zero. So who knows how long he's going to be there. But just because he may have a position now, this is not some big endorsement. This is one guy who's in the fringe kind of the hedge fund world acknowledging that he's doing something extremely speculative by taking a flyer on Bitcoin, but he has a feeling that it's going to work out because he thinks that we're going to have all this inflation and gold's going to go up, and so people are going to be looking for inflation hedges. I think he's wrong. You know, and I heard people tell me, hey, Peter, look, it's just 1%. Why don't you put 1% of your net worth in Bitcoin? And, you know, I'd rather put another 1% in junior mining stocks. I mean, if I'm going to take a big gamble, because that's what Paul Tudor Jones said. He thought that the upside in Bitcoin was greater than the upside in gold. So he thought there was more potential. Now, I don't think he appreciates the downside risk. I mean, he does. But I think if you weigh the upside potential relative to the risk, I don't think Bitcoin is a better risk-reward dynamic. Now, maybe if you think the upside potential is $1 million or something crazy like that, then you may come to that conclusion. I just don't think there's that much upside relative to all the downside. Yes, could Bitcoin end up going up more than gold for a period of time? It could, but I don't think it's worth the gamble that it might, when I think the odds are that it won't. But getting back to these, the mainstream guys, so are they going to take a chance? I mean, even Jones admitted on the CNBC interview that gold has a long history and a long track record, and it's proven. And Bitcoin is the new kid on the block. It's very risky. It's unproven. And so even the guy that owns both, right, has very different views of gold versus Bitcoin. One is a conservative store of value, and one is a flyer, right, that he's taking a shot on. As more people in the mainstream finally decide that they got a hedge and there's inflation, they're going to choose gold. They're not going to go from nothing to Bitcoin, right? They're going to go to gold before they potentially take a shot at Bitcoin, and then only with a small amount of money. But of course, if Bitcoin has already collapsed by then far fewer investors are going to be pressured to go in it. Because I think right now, when people see the big gains, hey, why did you miss out on that? Why didn't you get in? But once Bitcoin really starts to fall, then it's the people who got in that feel like idiots, and the people who avoided it can look like the heroes because they didn't fall for it. And that's when you get the real big PR problem for Bitcoin, right? When you have all these horror stories, not a bunch of get-rich stories where high school kids took their bar mitzvah money and became millionaires because they bought Bitcoin. Then you're going to hear stories about people who went broke buying Bitcoin because they invested a lot more than bar mitzvah money, right? They took their house money, they borrowed money and bought in at Bitcoin at a much, much higher price. They got in at the end of the bubble, or as the bubble was deflating, rather than early on, right, before much air even got into it. And so once Bitcoin has that really negative PR problem, it can't shake it, and then that's it. Then the party is over. But anyway, we're again 8,800 and change now. We'll see what happens tomorrow. Ben Bernanke is talking, so the markets are probably not Ben. Tomorrow, Jay Powell is talking. We had a few other Fed guys out today, but of course, none of them have the status as the chairman himself. So the markets are really going to be looking to what he has to say, potentially about negative rates. I am still looking for a big break in the dollar. I haven't had it yet. Still looking for a big move up in the price of gold. I think it's getting ready to happen. Hasn't happened yet, but I think it is going to happen any day. But anyway, I will be back again with another one or two podcasts later in the week as the markets develop. Again, we went off on a very, very weak note for the stock market. So I think we could be in for some interesting action in all the markets in the days and weeks ahead. Bye-bye. Which is now weak and below estimates, that is going to turn around, that the other data is going to strengthen to be in line with the jobs data. After all, if we have this strong jobs market, we have the strong economy, the rest of the numbers should turn around. I think that's unlikely. I think what's far more likely is that the jobs numbers weaken in line with everything else. In fact, I think it's more likely that we end up getting a lot of revisions in these job numbers that show that they were never this strong the entire time, that the numbers that we were getting were painting a unrealistically positive outlook on the economy or unwarranted strength in the economy based on these job numbers. Maybe it was because of the birth death model having overestimated how many companies were created on a monthly basis and ignoring the reality that a lot of companies were probably going out of business during that time. So my expectation, again, is that the jobs numbers come back down and we will be in a recession. I think the recession, if it's not already here, and again, you can argue we've been in recession the entire time, but for these phony numbers. But I think before the 2024 election, and probably well before, I think that we're going to have to acknowledge the fact that we are in a recession. But contrary to what investors expect, and that's why the stock market keeps going up. We just finished another week, another up week. The NASDAQ today closed at a new 52-week high, not a record high, but this is a new high. We're in this big bull market now in the U.S. stock market, having risen, more than 20%, quite a bit more in the NASDAQ from the 2022 lows. And what's really driving the increase is the idea that the Fed is done. It's either close to the end or finished with the rate hikes. The only index that was down on the day was the Russell 2000, but even the Russell 2000 had a good week despite giving up some of those gains today. But I think the market's expectation of the rate cuts is misguided. I think they're right. We're going to have a recession and the Fed is going to pivot and the Fed is going to start to cut, but it's not going to cut nearly as deep as the markets expect. And I'm going to talk a little bit more about that the Fed is not going to hike rates at all during the June meeting. And I think when they do that, they are going to do it in a way that it doesn't indicate that they're done, that they're kind of taking a break, and that the rate hikes may in fact resume at the following meeting. Because I think they want to kind of take a little bit of the sting out of the fact that they don't want to admit that they're done. They want to soften that. So they don't want to be as dovish as they could, because the markets still expect a hike. So I think if they don't hike, although there's still, a pretty decent probability that they don't, it wouldn't be a complete shock if they didn't hike rates, because I think a lot of people, it may be in the minority, but it's a significant minority, expect that the Fed won't move in June. And so I think they're going to try to act as if they just want to be a little more pensive. They want to be data dependent before the next hike, right? They've hiked a lot, and we don't necessarily need to hike at every meeting anymore. But I think they still want to maintain the bias towards hiking. But I think that if they blink next week and don't hike, I don't think they're going to hike again. They may pretend that they're going to hike again, but I don't think that's their plan. In fact, I think if they don't hike next week, the next move is going to be a cut. Don't know exactly when, but I think it'll be before the election, but there will be a cut. I think this is going to be like that mid-course correction from, I think it was 2019, when the Fed stopped hiking rates back then. And when they did it, they said, well, this is a mid-course correction. They tried to create the impression that they're going to keep hiking. They just needed a small correction from the previous hike before they resumed the hiking cycle, right? They didn't say we're done hiking and now we're cutting. They pretended that the cut meant nothing, that it was just a little mid-course correction, but we're still on course. We're still on the same course of raising rates. We're just correcting that course a little bit with this cut. Well, at the time, I was on my podcast saying, BS, that's it. The Fed's not hiking anymore. It is changed course. It didn't correct the course. It did a 180, and it's going back the other direction, and we're going to get more cuts. And of course, we did. We ended up at zero following COVID. So I think when the Fed tries to indicate this pause, this whatever it's going to be, as for why they didn't move in June, they're going to leave it open that they might go in July with another 25 basis points, or they might go in August. It's kind of data dependent. But again, I think this is the end of it if they pause. What's also going to happen, and one of the reasons that they're pausing, is that the economy is weakening. Forgetting about the jobs data, the economy is weakening. The Fed knows that. And so the Fed doesn't want to continue to kick the economy while it's down, particularly the banking sector. The Fed doesn't want to keep raising rates. I called up Bank of America today. I had a little money over there in this account, and I deposited a check there, and I had the savings account there. And since I put this check in there, I was curious, what's my interest? I hadn't really been paying attention to this account. And I said, well, the interest rate is zero. And I said, well, do you have another account where I can get any interest at all? Is there any savings account that pays any interest above zero? And the agent told me, no, that's it. There's no way to get more than zero. They said they do have an interest checking account that I could get. No, excuse me. It was my checking account that was zero. And I said, are there any checking accounts that pay more than zero? They said, no. They said, if you open up a savings account, though, without checks, then you can get interest. I said, okay, how much? 5 basis points. 5, not even 50, 5, like 1/20th of 1%. That's it. I mean, how is a bank going to survive when it can't pay more than 5 basis points, when the Fed funds rate is 525 basis points? And I talked to this guy at the bank. He said, well, a lot of